Okay, hi there. Geoff here again with another update on the UK economy. Exams are coming into focus. Students are looking to update their knowledge on the UK and the world economy. So I thought I'd present to you my latest data, my latest comments and thoughts on where the UK is heading as we go into a crucial period of the cycle. Feel free at all times to press the pause button if you want to take a screenshot or add to your superb revision notes. So here we go. The UK economy returned to growth in 2021 after the pandemic. Of course, don't forget we lost 11% of GDP in the first lockdown. Output grew by 7.6% in 2022. But notice there the slowdown in 2021. So in 2022 saw a slowdown with growth of only 4%. Now, there's a lot of uncertainty at the moment about what's going to happen in 2023. Will there be a recession? I think the answer is probably yes. We may well lose about 0.5% of GDP, but it's going to be a shallow slowdown, and some people are still forecasting even growth in this year. But I think the key thing is that the economy of the UK is still vulnerable to and affected by external shocks, one of which is the world price of gas, shown in this chart. This chart shows UK gas prices in terms of pounds per therm. Therm is a unit of gas energy. Now notice from 2008 all the way through to 2020 and 2021, the price of gas coming into the UK was low and stable. In other words, the economy could rely on a steady and cheap supply of gas. Perhaps we became too dependent on that. And then suddenly the price of gas starts shooting up. It effectively more than quadruples in 2021, and then another sharp spike as the consequences of the Russian invasion of Ukraine became apparent. The UK, of course, is a net importer of gas and oil. So suddenly the world price, and reflected in the price that we pay, went up. Partly, of course, that was the fall in the exchange rate because gas is priced in euros and dollars. And if the price of gas, so if the pound falls, if the pound goes down against the euro and the dollar, we have to spend more in pounds for our gas. Now, crucially, that's a major shock. And that's going to affect both aggregate supply in the short run and aggregate demand. I wonder if you could visualise the diagram you might want to draw there. Gas prices have come down. They've come down quite sharply from their highs of last year, although they haven't come down to where they were. So the point I would take from this chart, something to be aware of in the evaluation, if you get a question on this, is that the UK economy may well have to adjust to a higher level of gas prices going forward. And that's clearly going to affect both households and businesses. Now, there's a level of stress as exams go up that rises, doesn't it? And the economy also has stresses and strains. Ian Stewart and his team at Deloitte have this what's called economic stress index. Basically, when this chart's going up, things are getting worse, getting stressful. When the chart's low, things are a little bit more subdued and calm. And they look at things like unemployment, bank write-offs to households, how many people are having their mortgage house repossessed, how many firms are going bust, and it shows that there is a level of stress higher than there was last year, but it's lower than the pandemic and much lower than the global financial crisis. You'll have been following, no doubt, the bank failures in recent weeks, the financial fragility there, and I've done a special video on that. Might be worth going back to my video on why banks fail, again a cause of stress in the UK. Now, this level of uncertainty is reflected in this chart, which basically is an index of consumer confidence. And we ask people, are you more or less or just about the same in terms of your confidence or about the next 12 months? Will you still have a job in a year's time? What's your income going to be? Can you live off your savings? And the crucial point, I think, to take in from this chart, you don't need to memorise it for the exam, is that consumer confidence took a beating in 2021, 2022. It's fallen back to levels last seen in the 1970s. When I was wearing flared trousers. So low confidence, think about the consequences there for savings behaviour, people's willingness to take out loans, for example, people's willingness to commit to big ticket spending. A lot of bills to pay, energy and food bills, less confidence about what the amount of money people have left to spend on other things. So overall, I think 2023 is likely, lots of uncertainty, of course, likely to be a year of perhaps a shallow recession, not as bad as the financial crisis, 4.5% lost output, not as bad as the pandemic, obviously the economy locked down, minus 11%, but we may well suffer a fall in output. The IMF published this data, it's on the right-hand side there, showing that we'll be the only country experiencing recession in 2023. But keep in mind that Germany is as close to it as just as makes the difference. And none of these countries is growing particularly quickly. So 2023 is going to be a difficult year for the world economy in general. Indeed, this is really key. This chart shows GDP, the index of GDP, with the base level of 2019. And you can see that the economy was growing before the pandemic, not very quickly. Then it fell off the cliff, recovered, and has now basically flatlined. Growth in GDP has been only about 1% a year per annum over the last decade. That is slow growth by any stretch of the imagination. And it clearly has consequences for lots of things. Our living standards, the amount of money that businesses make, and also critically, the amount of tax revenue that the government gets. Slow growth can be quite damaging in terms of living standards and raising the taxes needed to pay for government spending. So output in the UK is basically below the level it was before the pandemic. And of course, had we continued to grow from 2019 onwards, it would be at a much higher level of output. That said, the output gap, the difference between actual GDP and potential GDP, is, according to the latest OBR forecast, is going to be positive. In other words, the economy is operating a little bit above its potential, suggesting perhaps some demand pull inflationary pressures. It's one reason why the Bank of England may be reluctant to start cutting interest rates just yet. So the output gap is positive only a year after the economy reopened following the pandemic. And I think that's a reflection of the fact that there are big supply side challenges facing the UK, including low capital investment, weak productivity growth, and rising economic inactivity. Now, one of those is low investment. This chart shows the real level of investment in the UK, gross investment, some of which just is replacement investment for worn out, obsolete machinery. But can you see here that there was growth in investment before the pandemic, although it's flattened out quite a bit after 2016? Is there a Brexit referendum hangover there from that? Then we obviously had a fall in investment during the pandemic. That's inevitable. It's picked up a little bit since, as you'd hope, but actually gross investment is still pretty low. We'd want that to be higher, yes? Low investment limits the UK's supply side capacity. And Britain, I think, only invests somewhere between 17 to 18% of our GDP. And that's much lower than other countries such as Germany, United States, South Korea, and many other advanced nations. So low investment is a problem. The government's trying to address this with the super deduction tax relief, 100% capital expenses announced in the budget, special economic zones, and so on and so forth. Although be aware, of course, that the main rate of corporation tax is going up from 19 to 25% in April 2023. Now, inflation. Inflation, of course, has been one of the big topics in recent times. Have we reached peak inflation? Well, CPI inflation probably peaked at 11.1% in October 2022. The OBR, the Office of Budget Responsibility, forecast it's going to fall sharply to 2.9% by the end of the year, although the most recent data shows inflation nudging up to 10.4%, largely on the back of a significant increase in food prices. The blue line there shows inflation, the orange bit shows interest rates, which I'll come to in a second. It's pretty easy to see where inflation has come from. This takes us up to the end of 2022, and the bulk of the contribution inflation came from the yellow and the blue areas, which is basically housing and household services, so that's things like rent, energy bills, food and drink. So a lot of the inflation is from energy and food prices, over which the central bank, in our case the Bank of England, doesn't really have any control. So it's a great evaluation point. If most of the inflation is caused by external forces, global forces, central bank's interest rate policy has little impact. Now, we do know that inflation is regressive. Food price inflation in particular is very high at the moment, somewhere between 15 and 20%. And typically the poorest 10%, if you look at this chart, go to the left-hand side of the chart, the poorest 10% spend over 48% of their disposable income on just food and drink and housing, whereas the richest 10% only spend 26.5%. So, when most of the inflation is food and drink and energy costs and rental costs, it's pretty easy to see why inflation has a regressive effect. It hits relatively poorer households hardest. By the way, again, as we go through this video, Don't forget to press the pause button or come back to the video anytime you like, as you may be working through your own revision notes. This chart shows how people have responded to a cost of living crisis. Many people are spending less on clothing or travelling less, are putting off maybe a big purchase. I, for example, have spent far less on hair and beauty this year than I normally do. And quite a few people even cutting back on the old Netflix subscriptions. And one of the reasons, of course, is because real disposable income has taken a big hit. Now, real income adjusted for inflation, disposable income after tax and benefits. And you can see here the fall in disposable income from 2021 onwards, down from £21,700 on average to just over 20,000. So there's been a big hit, over £1,500 fall in average real household disposable income. It's forecast to pick up a bit in the next couple of years as inflation goes up. But that's quite a sharp cutback in people's spending power. And the red lines here show the forecast annual change in disposable income. And that's a pretty sizable, deep cut. For the poorest fifth of the population, their income's gone down by 4% in the last 2 years. Whereas for the richest fifth, income's actually gone up. It's now 66,000 if you're in the richest fifth of the population. Wow, 66,000 after tax and benefits and adjusted for inflation. And their income's gone up. Now, what about interest rates? So inflation's gone up, hopefully coming down, but stubbornly may not come down as fast as we think. What about interest rates? Well, here's the interest rate chart I showed you a little bit before. And the latest figure, maybe to take into the exam, is 4.25% as of March 2023. UK interest rates basically were 10% in the 70s and 80s on average. From 2000 to 2008, they averaged, 5%? So if you look at this chart, we've had a decade or more of interest rates of averaging about 0.5% or maybe 1% or even lower. So that's now changed. Sub 1% interest rates became the new normal in the last decade. That's now over. Central banks have now raised interest rates up to 4% and above. They may go to 5%. And in many ways, that's a return to a normal level of interest rates. Now, that's clearly inflicting pain on the economy, from mortgage holders to businesses with debt. But equally, it does give the Bank of England a little bit of leeway to cut interest rates if we suffer a slowdown or recession in the second half of 2023. And it's not just the Bank of England that's been doing this. Central banks worry that some of the factors that have kept inflation low in the past are weakening. And a lot of central banks have now been raising interest rates to curb inflation. As you can see in Brazil, they've gone up to 14%. In India, above 6%. It's only really the Bank of Japan and China that have kept interest rates where they were 3 years ago. What about unemployment? What about jobs? Well, the long-term picture is good. Unemployment rates have been coming down, as you can see from this chart. It takes us all the way back to 1971. And the current rate is 3.7% of the labour force. That's good news. But just dig beneath the surface a little bit. Things are happening. The progress we've made in bringing down economic inactivity seems to have stalled. From 2010, 2011 to 2019, we got an extra million people, essentially, pretty much a million people, back into the labour force. This chart, by the way, shows the number of people of working age, 16 to 64, who are no longer actively either in work or looking for work. And there's many reasons, including full-time students, early retirement, chronic ill health, etc. But notice what's happened in the last few years. There's been a significant rise in economic inactivity. Indeed, the UK labour force as a whole is smaller than it was in the year before the pandemic. Just over 2% of the workforce have left work since 2020. And some of this is linked to chronic illness, including sickness linked to long COVID. It's also linked to big delays in terms of receiving necessary NHS waiting lists. Some people have decided to recalibrate their work-life balance, perhaps because of the consequences of COVID on their family. Either way, there's been a big rise in economic inactivity, which is a constraint on supply. And interestingly, it's one of the reasons, I guess, why there's still over 1 million job vacancies. That figure's come down a little bit, 1.1 million now. It was, I think, 1.3 million. So the UK economy is growing, but yet we still have well over 1 million job vacancies. I want you to think about why that happens, what the consequences are, and perhaps what What can be done about it? Migration is helping to expand the labour supply. Something like 6 million people in work, or about 1/5 of the workforce, 19% of the workforce, were born overseas. Now, the number of people coming to the UK from the EU fell sharply after the Brexit referendum in 2016. But actually, significantly, there's now a lot more people coming in from outside the EU, and the government's expanded the skilled worker visa scheme. They've relaxed the rules, so many more jobs now can apply for work visas, temporary. Hundreds of occupations now can apply for workers to come in, perhaps short-term temporary workers, and so on and so forth. The big rise in the blue line there is in part the significant return of overseas students following the reopening of the economy. Now here's the grey line showing net migration. So the government was committed to bringing down net migration to the tens of thousands. Well, it was 500,000 in the last year. That's a long way away from that target. And in many ways, most economists argue that migration of skilled workers in particular is good for both demand and supply. Now, trade is quite important. A word or two about the current account. The current account, of course, is trading goods and services, shown here in blue. Investment income from overseas assets, employee income, and also transfers balance. And you can see, hopefully here, that the current account deficit in the UK is now quite negative. Indeed, if you measure it as a share of GDP, our current account deficit is likely to be about 6% of GDP this year, or £150 billion. Reasons why? Well, of course, the trade balance has worsened. The UK is having to import lots of more expensive oil and gas and food and other minerals, other products. So our import bill's gone up, and our exports simply haven't kept pace. Export growth has been disappointing. The low exchange rate should have helped, but it doesn't really seem to have driven export performance. It may well be the case that, having left the single market, quite a few export firms have relied heavily on exports in the past are not doing as well. It's the elephant in the room, is the fact we left the single market. On the fiscal side, what about the national debt? Well, here's the latest figures that I have for the fiscal deficit, not the debt. This is how much the government borrows each year. And of course, after the financial crisis, it rose to 10% of GDP in 2009-2010. Gradual, painful reduction over the next 10 years as fiscal austerity kicked in. So the government was getting close to balancing its own books by the time of the pandemic. And then suddenly that fiscal target was blown out of the water by the pandemic. Government furlough schemes costing tens of billions of pounds, increase in welfare payments, and other increase in NHS spending commitments, obviously, during a pandemic, allied to a big fall in GDP. Don't forget, GDP fell by 11%. So the fiscal deficit ballooned to 15%. Dropped to 5% in 2022, but of course it's gone up recently, including the government's energy price support, the payments to households and businesses. So the UK government's running a deficit of about 6% this year. And the national debt continues to climb. Go into the exam, the national debt in the UK is about 100% of GDP. Don't worry if it's slightly smaller or higher. That doesn't matter. As long as you know that the UK's national debt is about 100%. Well, in other words, it's the size of GDP. It's £2.2 trillion. Interestingly, the UK government tends to borrow long. Take a look at this chart. This just basically shows the breakdown of government debt at the end of 2021. It hasn't changed really since. About 29% is the issue of bonds that are repayable between 0 and 7 years. Medium gilts, 13%, 7 to 15 years. A quarter of government debt is 15 years or more. So the UK government tends to borrow long, so therefore it won't have to repay the debt in the short term. And about a quarter of the government debt is now index linked, which means that the interest on the debt is linked to the rate of inflation. And this is really important, see the pun there, really important, that when inflation goes up, the government then has to spend more on interest for index-linked gilts in particular. 9% is national savings and investments, including premium bonds. Now, what that means is that if by the way, this chart, just shows the yield on debt. Basically, it shows the cost of borrowing. So, for example, the government spending is costing about 4% to borrow for 10, 20 years. That's the interest. If you look at this chart though, next year, 2023-24, the UK government is likely to spend over £2 billion a week on debt interest. That's the interest paid to holders of government debt. That's a big rise from previous years. And it does mean, in theory, there's an opportunity cost, because that money might have been spent on welfare, healthcare, education, defence, transport, etc. So debt interest is now the fourth biggest item of government spending. It's now bigger than social services and defence combined. That's a lot of interest because the debt's high and a lot of the interest is linked to inflation. Of course, you've got to pay the money, you've got to raise the money at some point, so they will try and bring down the deficit to control the debt, and that does require taxes to go up. The tax burden is currently at a 70-year high. What the government's chosen to do, firstly, is to increase corporation tax. You need to know that's going up from 19% to 25% in the next few weeks. Not every company will pay that. It's really only paid by the bigger companies making the high profits. The corporation tax is going up, and also the government has frozen income tax allowances. So that means that as your wage goes up, as your pay goes up, you may well end up paying more tax because you move into a higher tax bracket, if that makes sense. So what do we say? 2013 will be a tough year for the economy. Will there be a return to the stagflation of the 1970s? I think the answer is no. Inflation is likely to come down in the second half of this year, and hopefully later on interest rates will start coming down as well. But this has been a very tough period for millions and millions of people. Higher food prices in particular are biting and having a major effect on people's living standards. I was reading just today that 3% of the UK's population used a registered food bank in the last year. Now that is a sobering statistic on which to end, but it's an important statistic because it gives us a feel and a flavour for the challenges facing millions of ordinary working people in the UK during this important year. Okay, folks, thank you so much for joining in. I hope you found that useful. Take screenshots, add them to revision notes. Loads more videos as the exams approach, loads more revision videos on micro, macro topics on different countries, different markets. Hopefully you found them useful. If you did, could you please press like? We are super grateful if you do. Maybe think about subscribing to the channel. But most of all, stay healthy, stay happy, stay curious, and see you sometime soon.